Wondering if you should invest your emergency fund to beat inflation? Are you someone who sets money aside for financial emergencies? Well, it is a great job, but are you investing your emergency fund to beat inflation? Hello and welcome. I am Prarthana from Clear, India's largest tax and financial services platform. At Clear, we have assisted 6 million plus tax filers so far. Do subscribe to our channel to support us and get to know more about the best investments to reach to your financial goals. An emergency fund is a contingency fund which helps you manage a financial crisis. You must set a target date to build your emergency fund based on your current financial situation. It helps if you take stock of existing assets, if any. For example, divert any extra cash in your savings account or money left over in a fixed deposit towards your emergency fund. You must split up the money you require to build an emergency fund into monthly commitments. For instance, if you have collected rupees 3 lakh in 6 months, you must set aside rupees 50,000 each month. Create a separate account for the accumulation of an emergency fund. For instance, you must not withdraw money from your emergency fund until you meet your target. Thirdly, you must set up an auto debit feature on the bank account where you receive your salary to ensure a monthly commitment towards your emergency fund. Divert any lump sum amount you receive, such as bonus or windfall, towards your emergency fund. Have around 6 to 12 months worth of living expenses into your emergency fund. Here are some tips to keep in mind when parking your emergency fund. You must focus on the safety of the money in the emergency fund. Do not pick high-risk investments like stock and equity funds, as you could lose money if stock market crashes. You have to access the money in your emergency fund at any time. So, avoid investments such as PPF and NSC, which have lock-in periods of 15 years and 5 years respectively, as you can't access them in a financial crisis. Maintain a clear distinction between money meant for investments and funds kept aside for emergencies so that the decision on where to park these funds gets easier. Lastly, you must check the tax implications of various investment avenues to decide on a suitable investment for the emergency fund. You may prefer investing in stocks or equity mutual funds for your emergency fund to earn inflation-beating returns. However, financial experts say this is a bad idea as you could potentially lose the money you invest in the stock market. For instance, suppose you invest your emergency fund in stock and land in a financial emergency. You will have to sell your stocks at a loss if the stock market crashes. You must never invest the money for your emergency fund in an equity instrument. You must pick an investment that assures safety of capital for the emergency fund. You may want to chase returns through stocks to build an emergency fund. You must avoid doing this as stocks can give higher returns only if you invest for the long term. Let us take a look at this interesting case study. Suppose you have invested rupees 2 lakh in stocks for around 2 years in 2018 and 2019 to accumulate money for your emergency corpus. The stock market crashed heavily in March 2020 during the lockdown. If you had to liquidate the emergency fund for a financial emergency during the lockdown, you would have suffered a heavy loss. This table is showing why stocks are unsuitable for your emergency fund. I hope by now you have understood how to build an emergency fund. Comment clear if you are clear or drop your questions if any. Don't you want to know how to invest your emergency fund during times of high inflation? You can always store cash for a financial emergency. However, cash loses its value because of inflation, which is the rise in prices of goods and services with time. You can invest in a savings bank account for your emergency fund. However, the interest is around 3% a year, which is way below current inflation levels. Financial experts recommend investing in liquid funds, which is a type of debt mutual fund for the emergency corpus. It invests in short-term instruments such as treasury bills, certificates of deposit, commercial bills, etc. You get a higher return from liquid funds than savings bank accounts, and they are tax efficient compared to bank FDs. You can always invest in bank FDs for your emergency fund. However, banks charge a penalty for premature withdrawal, which is 0.5% to 1% of the fixed deposit interest rate. You can diversify your emergency fund across liquid funds, bank FDs, savings bank deposits, and cash to get returns close to inflation. However, you must avoid chasing high returns from your emergency fund, as the prime focus is capital protection and liquidity, not inflation beating returns and wealth creation. This table is showing where to invest your emergency fund. You need money immediately during an emergency fund. Make sure to have around 7 to 10 days worth of living expenses in cash for financial emergencies that can strike in hours. Moreover, you must have at least 1 month's worth of living expense in your savings bank account as reserves. You must have 20% to 30% of your emergency corpus in bank FDs, as they offer a higher interest rate than savings bank account. You can have around 40% to 50% of your emergency fund in liquid mutual funds. It is safer than any other debt instruments and earns a higher return than savings bank account. Moreover, you can redeem the investment in 2 to 3 business days and tide over a financial crisis. You must choose investments with high liquidity, which focuses on capital protection for your emergency fund. Avoid high risk investments like stock and equity funds, which are volatile in the short run for the emergency fund. Thank you so much for watching this video. If you have any queries related to investments and taxes, please comment them below, as we will address them as soon as possible. Stay tuned for more updates, and don't forget to subscribe to our channel for finance related content. Take care and goodbye.